Mundi togozira wa pagade. Sure, you did another Zambi. Alright, let's start with this example. You see, imagine a project that costs. Imagine a project that costs. Imagine a project that costs $1,000. Imagine a project that costs $1,000. Imagine a project that costs $1,000 and will provide three cash flows. And will provide three cash flows. And will provide three cash flows.
Three cash flow?
Cash flows. And will provide three cash flows. And will provide three cash flows. It will provide three cash flows of $500, $300, and $800. And provide cash flows of $500, $300, and $800 over the next 3 years. Over the next 3 years. Over the next 3 years.
$900?
Yes. I'm saying $500, $300, and $800 over the next 3 years. Over the next 3 years. First of all, assume there is no salvage value. Assume there is no salvage value. Assume there is no salvage value. There is no salvage value at the end of the project. Assume there is no salvage value at the end of the project, and the required rate of return is 8%. And the required rate of return is 10%. And the required rate of return is 10%. Full stop. Calculate the net present value. Calculate the net present value. Any guess as how we do this? From what we learned? Any guess? This one. Any guess? So what we have to do is let's go for solution. So here, net present value, just as I said last time, in this case, we have a project that will run for what? For 3 years, right? So you have made the predictions as how much cash will the project be giving in each and every year over the 3 years. So that means we have cash flow 1 over the discounting factor plus cash flow 2 over the discounting factor plus cash flow 3 over the discounting factor minus initial investment. We there, right? So have they been discovered?
Yes.
Oh. And him, the one who was giving fake love, is there.
I think he's detained or is under investigation.
That's too bad. So in this case, what was our first cash flow? 500. That's 500 over 1 plus what? 8%, which is 0.8 power plus 300 over 1 plus plus 0.08 to the power 2 plus 800 over 1 plus 0.08 power 3 less initial investment, that was 1,000, right? So you may do this and tell me the answer. And that's the rate we've been given rate of 10. You have with them?
It's 10%.
8. I said 8%.
You
The
said
required rate, I said 10? Ah, should be 8%, not 10. 8%. Complete that and you tell me what will be your conclusion based on what we ate. You there? Receive how much of the phone? Not yet. A lot of us don't have calculators. Our phones. That's the problem. You don't have the calculator in your phone.
it's not, I know it's no market.
If you do it like this, you put your phone the other way around. If you put your phone the other way around, you don't have those other commands. Serious. Those if you put your phone in a portrait way. Madam, yeah. Don't worry, every day is time to read. I'm still thinking of AKA. With all the life that he made, but just dying like that.
Modern so cool. It's not understanding.
For that. How many minutes can it take to solve this? How many minutes can it take to solve this? gravel. Let's do together. How much have you found?
700.
Not yet. No, you're taking much time. Alright. Let's do this way. So what we'll have there, it will come the same 500. This plus this you have 1.08 to the power is that, right? Then you have 300 over 1.08 to the power 2 is what? You get 1 point? This will depend on whether I'll say 1.0 1.08 times 1.08 get 1.1664 plus 800 over this is 1.08. You get the same 1.2597. This one, right? Now this minus 1,000. We there? Were you finding this?
Yes.
So why you adjust?
Yes.
Because it's only it's so there, that is what?
1.6.
1.6?
Yeah, 1.4. When you add 500 here and 300, then you subtract 157.
You add what?
500 here and 300. It's giving 1.6.
This plus this plus this?
Yes.
Then?
Over.
What type of mathematics is that? Before that, what's that type of mathematics?
Okay, I use different methods. I use different methods.
No, it's not right.
It's kind of like
Yes.
It's not like the game
It's better.
I use two different methods. It's just like
You mean you add this plus this plus this?
no, it's kind of like
That's what I'm saying. I did two different methods. It's one these guys are saying. I did two.
Answer is equal to.
No.
Because what I do is, for example, let's take you have 8 divided by 2 plus, let's take 20 divided by 2. This one, you can add this 28 over whatsoever. But not with different denominators.
I think you have to find
No. You guys, what do I do?
and then you divide.
We divide, right? So if you divide this into this, you get what?
Okay,
500 divided by 1.08. You get that? 4 right divided by 1.08. You get 462.96 plus there we have 300 divided by 1.1664. I got 257. 257.20. There you get that? That's 800 divided by 1.2597. You get it? 635. 07 minus 1,000. If you do all of this, what you get? The ones I give up? Can you mention as a figure? 355, right? Which is 2, 3. So this is your net present value. What did I say should be the decision? I gave about 3 possible outcomes, right? You recall? What would be the decision there? Calculate the net present value. So I said sometimes you may be given, say, comment on the solution. So last time the time I was lecturing, I gave about what? 3 possible outcomes in what could be the comment or the decision like, or like say, what would be the decision rule? You recall anything? We had positive, negative, and 0.
Yes.
What did I say?
It was actually, I think, greater than 1.
Exactly.
If the project is greater than 1, then the management can proceed with that.
The project.
But if it's less than 1, the management should abandon both the project. If it's 0, then it's an assignment.
So here, what should we say? What should be the decision on? So you have to continue, right?
Yeah.
Because what you look at, this is the present value of the present amount, right? Because this is what we have invested. This is the cost of the investment. While if you sum up this plus this plus this, what you get is the present value of the future cash flows. So from what you saw, adding this looked more than this. That's why you have this, right? Now it's like this was about what? 1,355. While the present value, the present amount is that. So it gives you the positive net present value. And then with this, as the project has what? Has to be accepted as it adds or it creates value to what? To the business. For body.
The 300, is it 355?
355.
It's 355 for device.
Yes.
You change the sum of those numbers and the 1,000.
Okay. Let's put another equal to here, right? What you got was 1,355 to 3. Now this, you are raising what? 1,000. So this 1,000 is the cost of the project, or is the present value of the present amount. While this amount here is the present value of all the future cash flows. That's what Jason was said earlier. So we are saying the difference between the future value, I mean the present value of the future cash flows and the present value of the present amount or of the cash. So the fact that we are getting more money, if we are to invest this, then this gives us what? An amount which is greater than 1. And if we are to comment, we would say the company should go ahead with this project as the project gives what? Value to the company. Let's have another one. This one I'll give 5 minutes. We should be done. Please. What about the
Is it possible to run off from activity to one test completes? Or are you supposed to do the exact thing that you have to complete?
I don't give the
Okay, I'm asking that the percentage that you say
the expected return. Yes,
So you don't use the 8%.
we have done it.
It's a 0.08.
What's happening? All right. So I'll give this 5 minutes. You should be done. Then we'll go to the other stuff. Is it okay? Man, we'll see. Alright, so write this. Yeah, you got to dictate, then later on you should do it 5 minutes. Alright, write this. Project 1 requires a $35,000 initial investment. Requires a $35,000. Requires a $35,000. Requires a $35,000. It requires a $35,000 initial investment, and will generate. Thank you. Zugu won't be, and then I'm missing that. It will generate. Let's open sign this. Sir, I'd like to see these videos in the Zvanga posts in Dorubi. How do people react to them?
Next week.
Asana mwere?
Ayunje. Agumali.
Ukufanya kisi ubirani. Auje natumiza moja. Maona ni exams as well to his email.
Oh yeah.
Yes. Then there's a wimbira phone soup.
Money.
Okay. Nila kaudu ndiri kulibe, just remind him. Mwina nizabira chamate. Yeah. This is Chinese the one I mean I'm gonna do that Chinese. Kuna meeting we did nice wow today now that okay. Nasabu. Yeah, Zoom would be better. I like these videos. But I let them have an experience first. So we say project Y requires a $35,000 initial investment and will generate $27,000 per year for 2 years. $27,000 per year for 2 years. Per year for 2 years. First of all. The target rate remains, or you can write the target rate of return remains. The target rate of return remains 12%. Remains 12%. Remains 12%. What is the net present value of project Y? What is the net present value of project Y? And give your recommendation. So I'll give you the answer. Or what I look forward to is to calculate. And you do this for 5 minutes. This is 28 past 9. And I expect by 9:35 we should be done. So it's like almost 6 minutes. And your answer should be around this. 10,631. Around this.
Okay.
Yes.
3 minutes. Too much? This what you think? That's over Mavraga Veda. Mavraga Veda, that's over much. Yarusa. Where is it? Where's the problem? How much have we fought? 13. And yes, brother, there. 9,000. Sister, brother, there. Receiver.
Where is the problem? To pay value. Okay, if I ask you, this project is for how long? 2 years. What's the first factor? Second. So why I finding it different? Probably those who solved it, they found it, they solved it wrong. So we have cat for 1 plus r power 1 plus cat for 2 over 1 plus r power 2 minus initial investment, right? So initial capital R2. So which is just the same as 27,000 over 1 plus what? 2%, right? So it's what? 0.12 the power 1 plus 27,000 0.2 the power 2 minus 35,000. Good.
Yes.
Alright, so then newly we have what? 27,000 over 1.12 plus 27,000 divided by what? This square is what?
It gives us
Give you what? Someone is calling it, so I will not use my phone. Can you? Nice. So we can pay. I'm the best calculator. Go back. Use the default calculator. Because it's the very same that I'm using. Yes, that's the one I'm using. Oh yeah, it seems you're finding problems.
No, my mistake was.
Yeah. So yes, right. There that means it's 1.12 times 1.1. If you don't want to square, you can just do this 1.12 times 1.12. You get this one. Or else, you're getting 25 for the core, right?
24,107.
Or 1.12 square. Where is square in that one? 25 to 2. I mean 4, right? You go on? 1.2544 minus 35,000. And this guy is this body. So start 27,000. It's okay. So we have like 27,000 divided by 1.12. Give what? 24, 107. So 24, 107. Which 1, 4 plus the next 27 divided by get 21, 524.23 minus 35. Can we add this? Can I reduce it as also? You get brief 7, 3, comma, get 11, carry 1, 2, 3, 6, 5. You get this? You get? If you add this, you get this, right? Minus 35,000. What do you get? You get this, right? Where are we getting it from?
Those are mistakes.
No, let me see what you guys have done.
That's really good. You can put 1.25.
How you got this?
Yeah. Yeah, exactly.
How?
The recommendations that you come up with this one. I just wanted to get it wrong because we made a mistake somewhere else. So you can make it wrong.
Zoezi ni masaa mawili. Yes, sister. How did you show? It's just simple stuff. Yes, brother.
We phenomenal. Your friend also told me, how are you doing this?
I don't know what happened.
Right, so what's your comment there? Let's see. When are you writing your mid-semester? Huh? Next month. When exactly? So let
6 months.
6 months. All right. What's your comment then?
They're basic.
So let
They're basic, we just have to give them this kind of figures and everything. That's where the problem is coming from. To be honest. They're basic.
you get used. So we are changing our do the other way. All right. Now go to our next. And our next is accounting rate of return. That's technique number 2.
Rate of return.
Yes, accounting rate of return, ARR. So there you went. Accounting rate of return is the percentage rate. Is the percentage rate. Is the percentage rate. Is the percentage rate of return. Is the percentage rate of return. Is the percentage rate of return that is expected from an investor. That is expected from an investor. That is expected from an investor. There should be an investment, not an investor. That is expected from an investment or assets compared to the initial, compared to the initial, compared to the initial, compared to the initial cost of investment. Cost of investment compared to the initial cost of investment. Compared to the initial cost of investment. Full stop. Typically, ARR is used to make capital budgeting decisions. Typically, ARR is used to make capital budgeting decisions. Capital budgeting decisions. It's used to make capital budgeting decisions. It's used to make capital budgeting decisions. For example, if your business needs to decide, for example, if your business needs to decide, for example, if your business needs to decide whether to continue with a particular investment, whether to continue with a particular investment, comma, whether it's project or an acquisition, whether it's project or an acquisition, whether it's project or an acquisition,
whether it's project or an acquisition, comma, an ARR calculation, an ARR calculation, an ARR calculation, an ARR calculation can help to determine whether going ahead is the right move or not. Can help to determine whether going ahead can help to determine whether going ahead is the right move or not. Full stop. We're there, right? So that formula for accounting rate of return. So right, ARR Let's say ARR, that's accounting rate of return. It's average annual profits divided by average investment. Average annual profit divided by average investment. Average investment divided by average investment. So there we go by this. You write where average investment, average annual profit, where average annual profit is equal to where average annual profit is equal to total profit over investment period divided by number of years. I think it's really right. I should write it to avoid confusion. I'll say where average profit or average annual profit is equal to total profit over investment period. Total profit over investment period divided by number of years. Number of years. And when you look at average investment is equal to book value at year one. Book value at year one plus book value at year two plus book value at year two. All this divided by, should be using divided by T. Remove there. All right. So let's try this. How to calculate ARR. How to calculate ARR. how to calculate ARR, how to calculate ARR. You there, right? So doing an ARR, right? Doing an ARR calculation is relatively simple. Doing an ARR calculation, doing an ARR calculation is relatively simple. And here are the steps for, and here are the the steps for. With that, right? Number one. Work out annual net profit of your investment. Work out annual net profit. Work out annual net profit of your investment. Question. This will be the revenue remaining. 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 After all operating expenses, after all operating expenses, comma, taxes and interest associated with. This will be the revenue remaining. This will be the revenue remaining after all operating expenses, comma, taxes and interest associated with implementing, and interest associated with implementing, and interest associated with implementing the investment or project, investment or project, investment or project, investment or project have been deducted. There. Let's proceed. Number two. If the investment is a fixed asset, if the investment is a fixed asset, if the investment is a fixed asset, such as property, if the investment is a fixed asset, such as property, comma, you need to work out the depreciation expense. 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 We there, right? Number three. Then to arrive at the final figure, for annual net profit, simply subtract the depreciation expense. Simply subtract the depreciation expense from your annual revenue figure. Depreciation expense from your annual revenue figure. depreciation expense from your annual revenue figure. Full stop. Finally, you simply divide this number 4. Finally, you simply divide. Finally, you simply divide. Finally, you simply divide. You simply divide the annual net profit. Finally, you simply divide. You simply divide the annual net profit by the initial cost of the asset or investment. Finally, you simply divide the annual net profit by the initial cost of the asset or investment. Full stop. The calculation will show a decimal. The calculation will show a decimal, comma, will show a decimal, comma. So you multiply the result by 100 to see the percentage return. So multiply the result by 100 to see the percentage return. First of all, we're there, right? What do we make out of what we've just written? Okay, the last statement I said, number 4. Finally, you simply divide the annual net profit by the initial cost of the asset. By the initial cost of the asset. By the initial cost of the asset or investment. Full stop. The calculation will show a decimal, comma, so multiply the result by 100 to see the percentage return. So what do we make out of that? What do we make? When here we say book value year 1 plus book value year 2, then we will look at the value of the asset from the beginning and at the end. With there, right? So that you find the average. And as just we have said there, we talk of depreciation. What is depreciation? We talked about it last time, right? So if it's a fixed asset, you need to calculate the depreciation in that depreciation is the loss in the value of the asset. So definitely, for us to do this, our methods will be on the calculation of the average annual profit and average investment. They will just fit in the formula. So in our next meeting, just write example. So we'll pick it from the example itself. All right, so let's have the signatures.